You're listening to the Practical Wealth Show with Curtis May.
All right, guys, welcome to another episode of the Practical Wealth Show. I'm honored to have a great guest. He's actually the host of his own popular podcast called simplepassivecashflow.com. I have Mr. Lane Kawaoka with me on the show. Hey, Lane, how are you?
Hey, aloha, Curtis. How's it going, man?
Oh, I'm doing great. So let me tell you a little about Lane before I let him kind of do, we start our conversation. Lane currently owns, you need to hear who you're talking to here. He owns 3,000 plus units across the U.S. Okay, he lives in Hawaii. So I'm jealous. If I'm going to be on lockdown, I'd rather be in Hawaii. and his day job he recently quit his day job as a professional engineer with an MS in civil engineering, construction management, and a BS in industrial engineering. Lane partners with investors who want to build their own portfolio but are too busy to mess with tenants, toilets, and termites. Now you're speaking my language, all right? Because I'm lazy and unhandy, all right? And by curating opportunities in his...
Yeah, Hui Deal Pipeline Club is what we call it.
Okay, Hui Deal Pipeline Club, thank you. And where his investors have personal access to him, and that he knows that he's personally putting his money on the line too. His club members acquired over $250 million of real estate by syndicating, and he's done that since $25 million since 2016. And so what Lane done is he reverse engineers wealth building strategies that the rich use to the middle class via the top 50 he's got basically the top 50 investing podcasts in the country. Lane's mission to help hardworking professionals get out of the rat race. One free strategy call at a time. Lane, welcome to the Practical Wealth Show.
Hey, thanks for having me, Curtis.
Pleasure.
Yeah, so I'm just kind of mostly like everybody else. How I got started with this, I went to school for engineering, and my parents were kind of lower middle class, trying to tell their kids to go to school and get a good job and work at that job for 40 years. I went and did that. My job kind of sucked initially, which is why I got this bug to do something different. So I still following that linear path myself. I bought a property in Seattle to live in because I was never home, because I was the guy who always had to travel around for work.
Okay.
I started to rent it out. So for a young 20-something-year-old kid, it was $2,200 a month rents, and my mortgage was $1,600. So that was a lot of beer money to me at the time.
Right.
And after I spent a lot of beer money for 1 month, I realized, wait a minute, I should probably do this again and again and again, and this will be my ticket out of the rat race. So that was how things kind of started for me.
Okay. When was this? How long ago was this?
This was back in 2009. And then 2010 is when I really kind of started getting those renters in there.
So right after was this still in the meltdown on the tail end of it?
Yeah, I would say this is in the melt. I mean, I don't think things were like going down anymore. Things were kind of in the doldrums for like 2-3 years. Things didn't really start to pick up to 2012.
Mm-hmm.
And yeah, that's what, I bought another property in 2012, and then the prices started to go up. And then I learned, sophisticated investors who are looking for cash flow don't invest in primary markets like where I was, Seattle. They don't invest in California or Hawaii or New York or Boston. They go after where the rent to value ratios are 1% or higher, so they're able to cash flow.
So talk about that. We have affinity for turnkey real estate is what we call it. And so you were busy traveling all the time, so you didn't have time to drive for dollars or manage a construction project. How did you get yourself really on the map?
So I'm not, this is not really for, just for new people. It's mostly new people with, pretty good salaries, right? Or the people I work, doctors, lawyers, engineers. Because the brand of investing I don't do wholesaling or flipping or any of that stuff.
Right.
The stuff I do, you need
which
money
is really
to
not investing, truth be told. It's really more, it's really a business.
Right. So anyway. Unfortunately, that's what everybody's doing who's going to the local RIA, who has the time to do that, or some free internet forum, right? They're all the active guys.
Right.
Or, people don't have money.
Right.
which is great. I mean, I guess you got to start somewhere. But my thing is I had a good paying salary, and my highest and best use was at my day job. So I just saved up, no tricks or games. I just saved up the 20% down payment and just kept acquiring properties. And my secret sauce was I just was pretty frugal at the time, and I just saved up my money. Go figure.
Yeah, I mean, it's funny. We teach last week. We went over the 5 principles of. It might be last week from this interview, but we teach the 5 principles of personal finance, and principle 1 is save 15% of your income or more. You have to work. You've got to save so that you have capital to buy assets. It's no trick play. That's blocking and tackling. So if you make good money, that's just a good strategy for you.
Yeah, most of my clients that invest with me, I mean, they're at least $30,000 a year is what they net. I mean, and that's all I care about is what do you net? I don't care if you make $200,000, $300,000. At the end of the day, what do you save? What are you able to put in the bank account as savings every year?
Yeah.
I mean, I got a lot of guys in San Francisco, they make over $300,000, yet they are only able to save $8,000 a year. And I'm like, geez, that's a rounding error or something. It must be wrong, or
Right.
you only save that much money, And
what happened? Why do you think that is? What is the problem you see with them, the people where they're making good money but they're not saving?
It's the keeping up with the Joneses, or they have a spendy wife or spendy husband, and like their cars. They're just not conscious of it. But I get it, because if you're investing in garbage investments like Wall Street, what incentive is there, right?
Right.
It's if you're putting in your money into some like checking account or savings account that gives you 0.01%. Yeah, I get it. I wouldn't be too much interested in it anyway. But if you're able to find a mechanism, something like turnkey rentals or syndications,
right?
Let's take a turnkey rental. You put $20,000 down on an $100,000 property that produces $1,000 a month rent, that produces a couple $100 of cash flow. Now you're oh, okay, I'm going to tighten the belt a little bit to save $20,000 a year so I can create a $200 a month cash flow stream for me. Now I'm motivated.
Right. What are you working for? Because I always tell people investing is a plan, right? So it's got to be focused on cash flow, and you're saving not to be saving, you're saving so you can buy assets that generate cash flow, right? Exactly. And so Lane's has kind of figured out that formula. Talk to them about, so now if you're listening to this and you're willing to save some money up, if you have a pretty good salary, here's a way for you to get into the real estate game without, painting or swinging a hammer. Because a lot of you say, oh, you hear about real estate, but you don't have time for all that stuff. You should be, you've got a successful business that you're expert at, or you're a professional, you're a doctor, you're an attorney with, and you're busy. And so, but you need to put your money to work. And so, but you mentioned something, so I want you to touch on that now. There's another level of this called syndications. Tell them about that.
Whether you go to syndications or something like turnkey rentals, which are all pretty passive, it's a combination of how much your net worth is and how much you're able to net at the end of the year. I have a graph on my website kind of outlining it, as every situation is different.
Right.
But for the most part, if your net worth is under $250,000 and you're not able to save at least $40,000 to $50,000 a year, I would say, and you don't have experience with this stuff, stick to turnkey rentals. But for those of my clients that are, making $200,000-$300,000 or more, definitely accredited investors. You don't need to be accredited, though. Well, no, you don't need to be accredited.
Need to be. Okay.
90 to 97% of deals out there are for non-accredited investors also. This is where networking comes in, right? Your network is your net worth.
Right.
Especially when your net worth becomes at least $500,000. So once your net worth becomes $500,000, I would say at least start to learn about the space. Heck, learn about it now, because all roads lead to more of the passive investor route. And I can talk more about my story of how I acquired 11 turnkey rentals, and I just realized it just wasn't scalable as a way of investing.
Talk about that, because I've thought about that. One of our listeners bought 3 last year, right? But, it's okay. And she's making 17, 18% cash on cash return on them, but you gotta keep doing that. And there's other levels of this, but I'd like to hear I want people to hear a real progression of success. So tell me a little about what you're doing. And then I want you to morph into where you store your liquid cash, because I want people to hear this. I've been telling this.
So like in 2010, I was picking up rentals after rentals. And around 2015, I got up to 11 rental properties. Do the math at a few $100s of cash flow each. That's $3,000 passive cash flow a month. Nothing to, complain about, right? This is going to come off really facetious, but it's like whoop-de-doo. Like, right. I'm going to need a lot more than $3,000 coming in.
Right. You can't pay. If you're making $200,000, you need $18,000 to get out the rat race, technically. A month.
Right.
Yeah.
I mean, more power to you if you're one of those fire guys who doesn't spend money on anything and just, boards up themselves in their house and rides their bike to the grocery store. Right. That ain't me, right?
You want to live your life.
I'm on the fat fire kind of spectrum. But yeah, 10 rentals equals $3,000 a month. With 10, 11 rentals, I had an eviction or two every year.
Okay.
And I had pretty good rentals. Mine's rented for at least $900 each. So none of these Class C properties or worse. And I had some kind of big issue that happened every quarter, like an HVAC goes out or a plumbing issue that flood the basement, some kind of vandalism or something. And which, those evictions and those maintenance issues are kind of no problem because I have property managers, right? I'm a passive investor. I'm not doing this by myself. I'm not unclogging toilets or fixing stuff. But at 30 properties to get up to 10,000 a month, you're talking on eviction every other month and some kind of big catastrophe, multiple times a month. And it's just not sustainable, not a scalable way of doing this.
Okay.
And also, investors need to have one eye on their return on equity. So initially, like you mentioned, your client, you might be making 18, 20, heck, 30% on your money. But as your equity position grows because you're paying down the mortgage and the property is appreciating, right, your return on equity goes down. Smart investors know that as that creeps down into the 15, 10% range, you either sell or refinance or you cash out refi to get that leverage point back up and keep doing that again. And when it goes back down, you re-leverage that sucker. So it's a constant game like that. And if you have 10 or 30 properties, this is obviously you're going to go crazy and you're going to make your lender really rich because that guy's just going to keep pulling in those origination fees.
Okay. Yep. You have to watch your money, but so you started to see that happening and then that led you to what?
Yeah, so around 2015 is when I kind of followed the breadcrumbs of, you hear about multifamily, multiple roofs, yada, yada. So I started to learn about it more. And then I started to pay for masterminds, get into different groups. I never did this before. I always just watch YouTube videos or podcasts or read books. That's most of my podcast initially was about turnkey rentals. And a lot of it, there's not much to it, right?
Right.
My buddy was like, "Oh, you're gonna write a book on turnkey rentals? What is it? Like one page?
Right. Save some money up, find somebody and buy it from."
Right. But then I started to learn about this world of syndications, or it's also known as country club deals, private placements. So there's this world out there of high net worth, mostly accredited investors out there, doctors, lawyers, engineers that net worth $1 million to $10 million. Well, what they're doing is they're going into multiple deals at 50, 100 grand a piece, and they are diversifying over different partners, different people who operate the deal for them, do all their dirty work, find the deal, finance the deal, operate it, do everything. Different guys, right? Because you really never really want to rely on one people. Different markets, different asset classes. Now I'm in mobile home parks, looking at self-storage, all kinds of things. And then, different business plans. So you're kind of getting rid of all the headaches and you're kind of relying more on the people side and vetting individual deals. So it's very different world than the pick up a property, all this old school, pick up a property, hold it. That's what your grandma used to do.
So you had to grow, right? I did a live the other day. I was saying, listen, if you're going to, you can't win as you are. You have to So you got all you could, is from what I heard was, or people actually what I think I heard, you kind of pretty much got all you can get out of books and free videos. You had to get around people that were playing at a higher game so you could play at a higher level.
Right.
A game at a higher level.
Right. I mean, I have this theory of, I took it from my old engineering days. Like the HR department had this thing of 70-20-10 rule, where 10% is the academic stuff. It's the stupid virtual based learning on the computer, CVT, I think they called it, and books. And this would be like podcasts and stuff like that.
Right.
20% is the people, right? Finding other people that aren't trying to get a paid off some kind of referral fee. They're just peers to you that you build real organic personal relationships with. That's 20% of it. But the 70% is just doing it, right? Putting your money in, right? That's why you hear it all the time. Just go buy the property, man.
Mm-hmm.
You know, get somebody around you to kind of quickly vet it for you that you trust. The learning doesn't start till you put your money in the game. You know,
since we'll go back to where you save your money at, but since that, let's talk about vetting. Like, you know, the assumptions in a performa is how you analyze the numbers and you see these opportunities. Let's say you're looking at these opportunities. What is your thought process in kind of vetting them? Could be going into a recession or in a recession. You know, what are your thoughts in terms of how to kind of protect your portfolio?
Yeah, well, it depends what kind of deals you're going into, right? Like most of the deals that I like personally are, you know, stabilized assets from the get-go. So you have non-recourse, long-term Fannie Mae, Freddie Mac debt. Stabilized meaning they're 90% occupied or better. And then there's a little bit of value add. Maybe we're rehabbing $3,000 to $6,000 per unit, new flooring, new appliances, but not really getting into like the cabinets or heavy construction or anything like that. Kind of lipstick on a pig.
Right.
And bumping the rents up maybe $100 or $2 per unit. So I think when you have that strategy, I mean, I think you can't beat those risk-adjusted returns. I mean, if the economy goes sideways on it, well, you just cash flow, right?
Right. Who cares about net? You can't eat equity. So you live on cash flow.
Right.
I can come to Hawaii and stay there on cash flow.
Right. As maybe you just put the equity build and the rehabs on hold, right? But cash flow is oxygen. You need oxygen to breathe before you do anything else. But going back to your, you know, vetting deals, you know, assuming everybody has a different investment philosophy and, you know, you're building your portfolio with multiple of these deals. I'm in over a couple dozen of these private placements, but my weighted average is my investment philosophy, what I'm trying to achieve. But I'll go into development deals. I'll go to assisted living deals, but most of my stuff is cash flowing based, stabilized from the get-go. But how do I vet those? So half of it is the person. Who is the person operating the deal? So here's a general rule, and I've lost $50,000 not following this rule probably twice. Is number one, it would have been mitigated if I would have built a relationship with somebody who didn't have a dog in the fight, somebody who knew this operator and has actually invested their money in the past with them.
Okay.
And that is a long game for sure, but it's the only sustainable way of getting consistent deal flow. Like I just got a random referral to work with these guys and they ran off with my money. You know, come to find out that referral was, you know, pretty weak, right?
Oh, wow.
You know, so it's this whole, that's why like, you know, my group coaching thing is big on building real relationship with other investors that you can use for a lifetime. I mean, it's the only real way of vetting sponsors and operators. So that's number one. Like I don't work with anybody I don't know, like, or trust, and 1 degree of separation at least. I want to know them personally.
Okay.
Number two is not all passive investors are going to be this way, but because I operate my deals too, I can underwrite deals. And so I pull the rent rolls and the P&Ls and I run the deal myself and underwrite the numbers myself and just make sure that the deal sponsor is using the right assumptions like reversion cap rate, rent increases per year, economic vacancy, what are their assumptions? Because you can use whatever assumptions you want to get whatever projected return. Like, you know, we all know what performa means, right? It's toilet paper in French.
Right.
So like what I would say is like most passive investors, they don't know how to do that. And I think, you know, you may have to pay someone 5, 10, 20, 30 grand to teach you how to do that. But if you focus on the people side and just kind of following what other people have done in the past, I think that's the minimum effective dose right there.
I agree. I think that but in Kiyosaki's book, he talks about financial literacy, right? And so financial literacy is accounting. It's the ability to read numbers. The numbers tell a story. And so if you don't understand the story, or you can't get somebody who can break the story down to you, and you don't have the relationship, that's probably not a good place for you to put your money. I always tell people not losing is winning. Okay, sometimes. And so that's a really good point. Thank you, because I think that's a good point. I want to get people into your head of when you wake up. Matter of fact, let's just ask, when you wake up, what are you thinking about? When you're working, you're in Hawaii. I'm thinking about going for a run down the beach. But like when you're in a work day, are you looking at deals? Or people bringing deals to you? I mean, how are you making stuff happen?
Yeah, I mean, at this point, I've kind of built like a lightning rod for passive investors, and people know that people follow me into deals. So the advice I give is not practical for most people. I mean, deals come to me, people court me for deals. They bring their deal to me, I look at it. But I mean, and people in my mastermind will be like, "Oh, what do you think about this deal?"
Right.
I'm like, I always ask this question, and they're like, "All right." Then the question is like, "How do you know this person? Who the F is this person?"
First question. Okay, how you doing?
And then it's like, "Oh, I just found it. I just randomly somebody emailed it out to a CC list. It's a daisy chain deal. I saw it on some internet forum."
Right.
I'm like, "All right, well, yeah, we're done. We don't even look at it." Right. Like I built my network up to a certain point where there's not a deal that I don't know about out there. And even if there is, unless I know someone in my network that knows them, that I can give them a call and say, "What's up with this guy, Curtis?" Right? Or, have you heard of this guy, or know a guy that knows him? I don't take a chance. Not in that position anymore. I used to do that, but
you don't have to.
Gotten burned by that in the past.
We go back to just to piggyback on that point. One of the things that we always tell people, your number one asset is you, and you have to invest in your mindset, your skill set, and your network.
Right.
And so his network is now growing his net worth, his cash flow, but he had to invest in his mindset, the skill set through the masterminds, where he had to spend money. Sometimes you have to pay just to be in the right room for who's not in the room. Okay. And to isolate. Lane, tell me, because I know your time is short, tell me about what you call Emergency Fund 2.0.
Yeah. So as a syndication investor, the minimums for these deals are 50 grand, right? And these deals are 1,001 deals. They're not just random deals. They're deals that were severely under market rents or huge upsides in potential for a little bit of value add. And they don't come around very often, right? They're very sporadic. Sometimes they overlap each other, right?
Okay.
And I have consistent cash flow coming in, filling up my cash reserves, just like how anybody would be looking to buy their next turnkey rental. They're trying to build up their reserves. But for me, I like to have at least 50 grand there waiting for me to, I call it like a bullet in the chamber, ready to go. But I use my infinite banking policy to have an extra couple bullets ready to go, where it's making a little bit of return in there, and I can use that cash value to get ready and go. Like most people talk about emergency funds. That's not the wealthy do. The wealthy talk about opportunity
funds, right?
Right. Yeah. I mean, I have a little guide of how I play. There's some other things that I use in my opportunity fund in conjunction with infinite banking, some other private funds. You can check that out, simplepassivecashflow.com/ofund.
Okay.
That's how I kind of pair that. But between my infinite banking is primarily the first source I go to, which is, you can take a quick loan from your cash value. Right. So effectively, if people don't, want a good example, like, if, say a deal comes up, boom, I got 50 grand in my checking account. It's going to that. And then a week later, Curtis is like, "Oh man, hey, I'm going into this deal. It's really good. Take a look at it." I'm like, "Oh shoot, I only have like 10 grand left. What I'll do is take 40 grand cash value from my infinite banking, and then I'm in the deal." and then hopefully there's not a third one. I mean, we'll have to pull some strings at that point,
right.
or what?
Gotta get some more money.
Then you let the cash, the cash flow build it up again.
So the cash flow from because I always tell people, look, when you use the policy, so when he says infinite banking, what we're talking about, guys, just to be clear, you know this by now, but it's properly structured dividend paying whole life is the best place to store cash. So he leverages his cash value to buy an asset. When the money comes back, he pays back the lien against his capital and puts it back into pays the loan down against the policy and looks for another deal.
Right. And then other things that I'll do, sometimes a deal will cash out. I'll get this whole bunch of money. Maybe that's the time to prepay this year's or even next year's,
Premium.
Premium, right?
Mm-hmm.
And then you can also load it up even more. We can overpay too.
Right.
So that's kind of the way I use it. I'm not quite an expert on all like the nuances of it, but I just know how to use it, right?
Right. Listen, you're an expert at. Nelson Nash said, "Look, you got to learn. You have to have two businesses. You got to have the business that puts food on the table. That's you as an investor, right? And then you got to have a banking business, so which is a place to store your cash. You got money to do your deals. So, but you're good at both. But you're like Michael Jordan of the first one." Or I'm older, so Michael Jordan, like Kevin Durant or something like that,
Yeah, or like Dirk Nowitzki. I'm super tall, but I can shoot too, right?
Right. Exactly. Let me end with this because I know your time is short. And if you were to say, if I'm a busy professional, and I got some money. I'm thinking of a person right now I know has $100,000 in an IRA sitting in cash and in savings, a doctor. And I'm going to send her this audio. What should they do? What should they be thinking about besides, call Curtis? No, just kidding.
Yeah, I mean, well, if they're brand new people, I've got kind of 3 rules. Like the first rule is like you don't invest or spend any money until you do at least 6 months of podcasts, books, etc. Most people burn way over that.
I love that. Yeah.
Number 2 is you don't do anything until you have like 1 or 2 people that you trust that don't have a dog in the fight. That's not going to get paid a referral fee or some kind of marketing fee off of you.
Yep.
To kind of just check you, right? Because people they do the first, which is the books and all that stuff, and they get like an action plan. Because I do like free intro calls for people and just get them straightened out. And the reason why I do that is because people waste so much time. Yeah. They listen to binge watch podcasts for a year and a half. And if you've been listening to podcasts for a year and a half, you've probably heard everything by now. I mean, I don't listen to podcasts anymore personally. And they come up with this weird like ideas of what their long-term plans are. I'm like, dude, where'd you get that idea from, right? If you would have had actually who is someone has, a little bit of experience, they would have checked you, right? And they would have made that you wouldn't have invested with that shyster, or at least I wouldn't have done that.
Right.
Third rule is like don't do anything until you get your spouse on board, but that's a little bit different thing.
Listen, you can start with that one, right? So, or they need to be someone board somewhere on there. Y'all got to be on the same page because that could be a problem.
Right, so. But little nuance to that is you got to find your pedigree, right? Like my investors are mostly higher net worth, high pay professionals, certainly accredited investors. And I tell them all the time, going to the local RIA or the free online forums is the worst place to go. You're not going to find your folks out there. They're going to be house flippers. You're just going to get confused. And the thing is with higher paid folks, certainly people, once you get over $300,000 to $500,000 net worth, this stuff gets super simple. There's one or two best practices that you can pick. And that's why, it's simplepassivecashflow.com, right? Simple.
Right.
Like, all the confusing stuff is the stuff when you don't have money. I don't do that
because they're trying to hit home runs. That's why I didn't show practical wealth, right? It's not 2 + 2 is 4, right? And so, here's what I was going to ask you, because you said something about you had people call it investor DNA. You had your outcome. So what happens is people focus on the investment, but you had a vision of what you're trying to do, and then you do things from a cash flow standpoint, mobile homes, this and that. So it's not about the investment. It's about your vision of what you're trying to build. Is that kind of how your mind works when you put this stuff together?
I don't know. I mean, maybe that's the engineer in me, but I don't have those. I do the opposite. I get momentum first. I buy I would start off buying single family homes that are 1% rent to value ratio or better.
Mm-hmm.
Simple. Just get going. Once you get that, you're going to have and you're only saving 10, 20 grand a year. Dude, you're going to have a lot of time to think about this on the journey. It's a long car ride.
Okay.
Right. Then you're going to buy your second, and then you're going to buy your third, and you'll be learning about syndications along the way and all these other things that the wealthy do, like infinite banking, all these like LLCs and like irrevocable trusts for legal protection.
Mm-hmm.
There's going to be a lot of this coming down. But the important thing is just kind of level up with the people around you, because the answers are in your network and getting associated with the right folks. That none of this, you're not going to have the vision. If you wait for the vision, none of this, you're not going to buy that first few properties to begin
with. That makes sense. Just take action. Activity. What do they say? Activity produces knowledge. So knowledge does not produce activity. So.
And another thing of that is like to get to yourself networked. I mean, yeah, you can pay for it, but if you're doing it the free, cheap, and easy way, or cheap way, you're going to have to bring value to these relationships. So unless you own stuff and you have some battle scars of your own, you're not going to bring any value to an interaction with another investor to be able to build that relationship. So you got to go get something to go level yourself up.
Well, you just said like gold, like 4 or 5 gold points. I hope you all taking notes while you listen to this. I have a page of notes and I'm doing the interview. All right. And Lane, what I know you got to jump with some other calls. What any closing thoughts? Any good books you're reading? Any place that you want to send people to find out more about you?
Closing thoughts, just go out there and buy something. I'm not a big book fan. Just get out there and analyze deals. I think people read too much books as it is, right?
Okay. All right.
Called self-help books. But yeah, if you guys are interested in, turnkey rentals, my first 20 podcasts were kind of all about that when I was doing that back in 2015, 16.
Okay.
Obviously my investment strategy has kind of changed more for the syndications, etc.
Mm-hmm.
And even getting outside of real estate too. Email address lane@simplepassivecashflow.com. If anybody wants to get a hold of me.
I'll put his podcast in the show notes. I don't want y'all blowing up his email. Unless you want me to, I'll put it in the show notes. Unless you have, $500,000 or more, then you can email. He wants your call. He's got something he can help y'all make some money.
Yeah. Buy Curtis a bottle of wine too. If you can't afford that, no.
So I'll get you saving 15, 20% or more of your income, and then we'll build your emergency fund. See, after 3 months, it's an opportunity fund, of your bill money. Then I tell you, look, now it's an opportunity fund. You should be going to look around for stuff. But listen, Lane, thank you so much. This was a lot of fun. I hope we can stay in touch. And I think you dropped a lot of gold for our listeners. And I just want to thank you so much for being on the Practical Wealth Show.
Yeah, appreciate it, man.
Yeah, my pleasure.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before